Welcome back to the fifth and final video of this masterclass. It's time to put all that we have learned into action now. So how do you go about selecting the best ETFs for your portfolio? We'll start with fitment. Fitment basically means making sure that the ETF matches what you want from your portfolio. First decide what assets you want in your portfolio. Then find the ETFs that match those assets. Once you have found a list of ETFs that fit your criteria, evaluate them using 3 specific metrics. Let's understand this with an example. Suppose one of the assets in your portfolio is large cap Indian equity. Your ETF universe to represent this asset are all the ETFs tracking the Nifty 50 index. You can also consider all ETFs tracking the Nifty Next 50 index. On the other hand, if your portfolio has a medium-term corporate credit exposure, you cannot take this exposure directly as we don't have an ETF currently that tracks corporate credit. So the next best thing that you can do is choose between Nippon India ETF SDL April 2026 or Bharat Bond 2025 ETF. Now, a lot of ETFs in India are not liquid. This means that when you buy or sell them, you can potentially incur significant transaction costs. So we need to make sure that the ETF is liquid enough. We must choose an ETF with narrow bid-ask spreads and large trading volumes. When considering trading volume, one should take an average of the trading volume over the last 1 or 3 months to eliminate the possibility of any recent spikes. The narrower the bid-ask spread and the higher the trading volume, the more will be the liquidity of the ETF. Next, we'll talk about expense ratio. Now, this is self-explanatory. Ideally, we would want to hold an ETF with the lowest possible expense ratio. And the last factor, tracking error and tracking difference. We have already looked at and discussed about tracking error. To recap, tracking error is the measure of the difference of the performance of an ETF with respect to a particular benchmark. On the other hand, tracking difference is the actual difference in return with the benchmark. Ideally, we want low tracking error and low tracking difference. Let's run through an example. Say we want to invest in a basket of Indian banking stocks. Here's how we will proceed. Step 1. Filter based on fitment. Here we select all ETFs tracking the Nifty Banking Total Return Index. The table below provides a universe. Step 2. Apply the liquidity screen. Now we apply the liquidity screen. The table below shows the average daily volume on NSE over the last 3 months. We have sorted this in descending order. Now at this stage, we are almost certain that we will pick the top 3 ETFs on the list. But we are not eliminating all others just yet. If big divergences show up in expense ratio or tracking error, then we will revisit these funds and do a secondary liquidity check. And step 3, finally evaluate based on expense ratio and tracking error or tracking difference. Nippon India ETF Bank Bs is the clear winner. None of the other high-volume ETFs offer a significant advantage in terms of expense ratio or tracking performance. But at the bottom of the table, if you look, we have Edelweiss Bank ETF, which is 0.14% cheaper than Bank Bs, and also in terms of tracking difference has a positive delta over Bank Bs. But on the other hand, it has a much higher tracking error and almost no volume. The market depth is very shallow. The bid-ask spread is huge and only one share was being traded at the time of writing this. What's more, the market price seems to be at a significant premium to the NAV. All these points are screaming red flags, and just a 0.14% lesser expense ratio is not worth it. So we should stick with Nippon India ETF Bank Bs. So that's a wrap for this masterclass. In case you want to dig deeper and know more, we have a detailed 9-page blog linked in the description box below. I hope this masterclass was useful and will help you get started in ETF investing. I am Sarthak, the Head of Wealth Management at AssetMent, signing off. See you soon.